What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. I'm going to be doing something a little bit different this week because I've had a lot of requests over the last while since I've gotten back on the YouTube to post full portfolio videos. Everybody wants to see my portfolio, the returns, things like that. And the one thing I will say is I do specifically reserve my overall portfolio, my returns, my weekly commentary on it, all my transactions to Stocktrades Premium members. I do this because, they've supported us for so long. They are one of the main reasons that I am able to do what I am able to do. And for that reason, it is inside Stocktrades Premium. But I am going to do a bit of a compromise because I do love talking about stocks that I own. And I'm going to, over the next bit, highlight some of the options that I do own, some of the options I plan to continue adding to. And ultimately, if you want to see that full portfolio, the returns, the transactions, things like that, you can join the platform if you'd like. But in this week's video, I'm actually going to be talking about a company we've covered for going on 6 years now and is actually one of the best performers inside my portfolio as of late. And it is a company that I do plan to continue adding to, and that is Aritzia. I'm going to dive into the company, the hardships it faced in 2022, and why I felt this was a bargain and did indeed add during that time, kind of the cyclical nature of a mid-tier retailer, the overall risk of the company moving forward, the overall potential growth of the company moving forward. And overall, I'll just do a deep dive into this company that I have owned for a very long time and I'm still quite a bit bullish on. So with that said, let's dive right into the video. As always, everybody, head down below, like the video, subscribe to the channel. If you want to see more in-depth stock analysis like this, I am going to be providing a ton more of it moving forward. And let me know in the comments what stock you want me to go over next. I am open to looking at absolutely anything. Doesn't necessarily need to be a stock I own or a stock that I research over at Stocktrades. I'm happy to dive into anything you want. So Aritzia, what exactly does this company do? Well, it is what I would call a mid-tier fashion company. It's not overly expensive like something like Canada Goose, but it's also not a discount clothing brand like one I could think of in Canada. Maybe a sports brand would have been Gildan Activewear. It lands somewhere in the middle, which does make it more susceptible to a weakening economy, the cyclical nature of that, but it also makes it so that consumers can hold on to that brand. If they really like the brand, they'll likely continue to purchase the clothing because it's not outrageously expensive during pretty much any economic environment, and we've definitely seen that from the company thus far. And overall, this company has just been one of the better performing Canadian IPOs over the last while. We've had a lot of poor ones over the last bit. I mean, I can think of the vast majority of IPOs during the COVID-19 pandemic. We even saw the IPO of Canada Goose that, caused a massive surge in popularity over the short term, but ultimately the brand kind of fell out, and I'm going to discuss that when I do talk about Aritzia. And then we've had, other notable options like Shopify, but Aritzia has definitely been up there. It's been a 5-year outperformer of the S&P 500, despite it taking an absolute beating in 2022 due to some particular inventory issues, which I'll go over. But overall, I still do really like this company from a growth perspective. And even though it's a Canadian listed company, my primary thesis for owning Aritzia is definitely the growth in the United States. And I'm going to dive into that in just a bit. So if we look to the, returns of the company over the last bit, we've seen returns have been very rocky. But if we look to 5-year returns, we're talking about, 133.5% versus around 75% for the TSX index. And the S&P 500 is, I believe, around 100% over this last while. It's pretty much been a double, where Aritzia has been a little bit more than that. So how has the company done so well, and what the heck happened to it at the end of 2022 heading into 2023? And the first thing I want to talk about is the actual sales growth from the company during the pandemic. So this is the comparable sales growth of Aritzia since 2019. FinChat actually doesn't have any of these key performance indicators before 2019, when in reality the company did IPO around 2017. We started covering it in, I believe it was 2018, It was around $14 or $15 a share. So comparable sales growth is essentially the growth the retailer can generate off existing stores. So you can look at total revenue for a retailer, and what this would do, this would account for not only its existing stores, but this would also account for new stores, or in Aritzia's case, boutiques that have opened up over the last while. And one of the reasons comparable sales are so important for a retailer relative to just overall revenue is it kind of highlights the growth in a company's brand, and it also kind of highlights the fact that you don't want companies that are, for the most part, exclusively growing due to new stores. New store growth is definitely a strong component of overall growth, but ultimately, if a company is only growing stores based on new store growth, that new store growth is more capital intensive than organic growth. And in addition to this, once that avenue is cut off, if the company isn't opening any new stores, growth essentially dries up. So comparable sales is a very effective way to look at the overall company results. And when we look at the comparable sales for the company in 2019, they sat at around 5.1%. So what comparable stores does is essentially compares the stores that were open a year ago today to the stores that were open today. It doesn't factor in new stores, and then it compares the growth in terms of sales of those stores. So when we dive into Aritzia's numbers, in 2019, they sat at around 5.1%. In 2020, they sat at around 8.9%, and then they absolutely exploded during the pandemic. Now, there's a few reasons for this. One of them being that pandemic, there was a lot of disposable income, which is going to impact a mid-tier fashion company, especially one that is gaining brand traction. It's going to get a lot more comparable sales growth. People got more money to spend. They have, generally they'll pay a little bit more for clothing in an environment like this. And ultimately we saw like 29.4% comparable sales growth, 28.3% when we go into the later end of 2022. And then when we hit February 2023, we had 32% comparable sales growth. And then you'll see that it absolutely fell off a cliff. And what exactly happened in 2023? Well, interest rates started accelerating. People started pinching pennies, cutting back. And ultimately, the company had a very, very hard time keeping up with these year-over-year comparables. What I will say, and I've mentioned this with Dollarama in the past, Dollarama grew comparable sales by 15.5%. And then the next year, they managed to grow them by 5.5%. So that's obviously a dip in comparable sales growth. That is because it's very, very hard to keep up with these comparables. If we look to May of 2023, where comparable sales growth grew 4.1%, we're comparing that to 2022, in which it grew 29%. This is very hard for the company to keep up, especially in the environment they were in. And in addition to this, we had a completely other element that the company got into a bit of trouble with, and I'm actually going to dive into that right now. This was not solely because of a decline in popularity in the brand. A lot of people during this time thought that Aritzia was toast. They thought the brand was dead. It was kind of a pandemic level fad. And when they saw this decline in comparable sales growth, they kind of thought, it's destined to underperform, something like Canada Goose, things like that. The brand is falling out. But the primary issue with it is when Aritzia was realizing this heavy same-store sales growth over the pandemic, it made what looks to be a very incorrect decision in ordering a ton of inventory at the absolute wrong time. And if we go to Aritzia's financials here, and if we look at the inventory levels, you're going to see exactly what I mean. We can look at an inventory chart here. Inventories remain relatively stable at around, anywhere from 171 million to 181 million during the peak of the pandemic when it's very, very popular. And then in 2022, they absolutely skyrocketed from 176 million to 510 million. And the prime reason for the company to be doing this was they felt that demand would continue. They couldn't keep up with demand during the pandemic. So obviously you order more product in the hopes of selling that product. And ultimately this was at a very, very bad time. And what happened was comparable sales growth fell. It actually went negative because people started pinching pennies in a very big way. And ultimately, if you're a retailer, you have all that inventory that you've paid money for. It comes out of the cost of goods, and you have warehousing costs to store that inventory, and you can't sell that inventory. There is pretty much only one way you can go about this, and that is through markdowns. You mark down the product in a big way. You mark down, products that have maybe fallen out of favor or products that weren't selling as good because of the environment. You now have to mark those down. And what that does is that really hits your margins. And we can come back to Aritzia's gross margins during the pandemic, and we can even see that they took a big hit. I mean, we're seeing gross margins of around 44% in 2021. That fell all the way to 38.4% during the 2023 penny pinching period. And that is a big dip in gross margins for the company. And ultimately, that caused it to hit earnings significantly. And that is exactly why we ended up with this big slide in Aritzia stock price. I mean, we can look to peak prices of $58 in January of 2022, all the way down to $21 in November 2023. You couldn't have been more bearish on this company in 2023. And a lot of investors were, because of this, not only inventory issue, but again, the fears of the brand falling out. So during 2023, I ended up adding quite a bit to my position. And I believe that position is up 115, 120% over the last while. It has performed very well because the company, it's looking like that inventory issue was the main factor for the company moving forward, because it turns out that it really wasn't all that big of a brand fallout. It truly was that inventory issue, just wrong timing, in my opinion, that caused them, earnings to take a hit and comparable sales to take a hit. And ultimately, as we're looking here in the latter half of 2024, we're seeing comparable sales growth that is now over and above what it was seeing pre-pandemic, and it is trending in the right direction. We've even seen gross margins trending back in the right direction. So as I mentioned earlier, my main thesis for owning Aritzia is that US growth. The Canadian market, I wouldn't necessarily say it's tapped, but the one thing about the Canadian market is obviously we're very small. We have a tenth of the population of the United States. And in addition to this, we arguably have, actually, it's not even arguable, we have a much weaker consumer here. The cost of living has went up way more in Canada than the United States. And ultimately, boutiques, they're a little stalled out in Canada, whereas the United States, the growth is definitely returning. So I'd like to show the chart here. Here it is, Canadian versus US revenue. And FinChat does have this from even its pre-IPO days, but I'm going to focus more on the, recent growth surge due to the pandemic. We can see back in 2021, the company had around 565 million in Canadian sales and around 291 million in US sales. Look at this growth in terms of US markets. We're looking at essentially from 2021 to 2022, US revenue more than doubled. When we go from 2022 to 2023, it nearly doubled again. And then as we head into 2024 and the last 12 months, we're continuing to see double-digit growth in the United States. Whereas Canada, it's still growing since that, penny pinching environment. It really hasn't grown all that much in Canada. You're looking at, in 2021, under 40% of the company's revenue was generated in the United States. And now you fast forward to, the last 12 months, we're talking like 56% of the company's revenue is generated in the United States. And you could argue that Aritzia has I wouldn't say a dominant market share in Canada, but they're a much more established brand in Canada. Whereas in the United States, they have a ton more room to grow. I mean, 1.3 billion in sales in the United States, considering the overall population of the country for a mid-tier fashion company, is, in my opinion, absolute peanuts. It has a ton more room to grow over the next bit. And the other thing I'm going to look at is the company is primarily keeping up with US expansion. That is their main goal right now. And we're going to look at the total boutiques, and you're going to see the Canadian boutiques have effectively flatlined. That is because we really don't have that many major populaces here in Canada to open up large-scale boutiques. I mean, when you think of the largest cities in Canada, we've got Montreal, Toronto, Calgary, Vancouver, Edmonton to an extent, but ultimately there's just not as much growth avenues in Canada for the company. And that's why you see in 2019, they had 67 boutiques, and we fast forward to 2024, they got 68. Whereas if you look to the United States, from 2019 to 2024, they've effectively more than doubled the total amount of boutiques that they have opened in the United States. And I would expect that to continue moving forward. Now, ultimately, I do feel that the company does have much more room to grow in the United States. The brand is untapped in that geographic sector, in my opinion. And overall, once we start to get declines in terms of policy rates, maybe maybe consumers are not pinching pennies as much, we might get people to open their wallets back up and start buying products from Aritzia again. And make no mistake about it, this company's US revenue is still growing at a very fast pace. I believe 23-24% year over year growth, whereas Canada is, it's lagging that bit. It's virtually flat. But again, this is in a relatively tight environment that it is growing at that pace. So I do believe when interest rates come down and more people are willing to spend, we're going to see that US growth accelerate even further. And in that situation, I do believe the company does have a ton of room to run. When we look to overall valuations of Aritzia, we're looking at 49x trailing earnings. But again, I don't use trailing earnings all that much. There was a lot of inventory related issues priced into last 12-month earnings, which ultimately have impacted it. The market looks on a forward basis. And in that regard, we're trading at around 18x expected earnings. And we have a PEG, which essentially factors in the price of the current stock compared to its relative expected growth. And you want to see a ratio under 1, a ratio of 0.27 would suggest, and it's not always cut and dry, but it would suggest that the market is really not pricing in a lot of growth for Aritzia moving forward. And I do believe that is kind of an element of the environment we're currently in. People just don't know the state of the economy, how much it's going to improve, and Aritzia is really going to depend on that moving forward. If we look to annual estimates, 92 cents per share last year. Last year was not a very good year for the company. They're expected to not double, but effectively double earnings on a year-over-year basis. And then when we look to 2026, this would be their fiscal 2025 earnings. They are kind of a year ahead of the calendar year. There's a lot of retail companies that do this. $1.71 in fiscal 2025. We fast forward to fiscal 2026. You're looking at $2.43. This is over 30% year over year earnings growth. And then we fast forward to 2027. Again, 2027, very hard earnings to predict, but we're looking at, another 30% plus earnings growth for the company. Revenue is expected to grow at a double-digit pace over that while, but I believe one of the main elements of earnings growth will come from margin expansion. The company does believe that margins will continue to expand moving forward as it kind of gets over that heavy markdown environment we were in last year. So I do feel that US expansion will be big for Aritzia moving forward. But the one thing about it is this is inside my portfolio, but is a relatively small position. It's around 2.5% of my entire portfolio at this point in time. And really, no matter how bullish I am on Aritzia moving forward, I would never really put much more than that into a retail company, especially a fashion retail company, because I have kind of learned a lesson in the past in terms of retail fallout and how fast it can happen. And that is in the case here of Canada Goose. I mean, I used to own Canada Goose. I bought it on its IPO. It ended up running up quite a bit, and I did end up getting a bit lucky and selling off. I believe it was around half of my position at the absolute peaks here. I held on to the other portion, and the company not only was hit pretty hard by the pandemic, but just overall, the brand kind of lost its power. This was one of the fastest growing retailers in Canada. Its jackets, very high quality. They still are, but the overall, I guess, novelty of having one quickly wore off. And this, don't get me wrong, this is a possible risk with Aritzia. We're seeing some headwinds with Lululemon right now. And the difference between a retailer and, say, a consumer defensive stock is a retailer consistently needs to adapt. They need to come out with new products. They consistently need to be changing in terms of the overall retail landscape to survive. You need a very strong management team to do so, and you constantly need to be adapting to the most recent trends, what people want to buy. So for that reason, I am bullish on the company, but I would never make it a huge chunk of my portfolio because there is extensive risk there. There's no way to sugarcoat it. There is retailers, when they fall out fast. Again, we're seeing that with Lululemon, and we're even seeing that with major brands like Nike. So ultimately, it's a small portion of my portfolio, but it has performed very well over the last while, and I do expect it to perform very well moving forward, but I also do acknowledge that there is a bit of risk there. So everybody, that's it for the video. Really hope you liked it. This is one stock out of my portfolio. I felt I would go over one of my holdings here again because a lot of people have been demanding a portfolio video, but again, I do reserve that for the premium subscribers. They've supported us for years. They allow me to do what I do on this channel, on the website, on the premium platform, and I'm truly grateful for that. So I do reserve it for them. If you want to join the platform, no pressure. There's a link down in the description. You can join that. You can get access to my portfolio, all my stock research, things like that. And ultimately, I want to hear your comments on Aritzia. drop it in the comments below. I want to know if you own this company. I know it is very heavily owned by a lot of Canadians because it's one of the faster growing companies in the country over the last half decade. And let me know, if you're bullish on it, bearish on it, if you're buying at this point, if you're holding, and also let me know what company you want me to go over next. And as always, stay tuned for more great investing content.